Welcome back, everyone. If you've been watching crude oil markets over the past few weeks, you already know that February and early March 2026 have been anything but quiet. Today, we're going to walk through one of the most talked about price moves of the year so far, that sharp 3% rebound in crude oil that played out on March 7th. We're going to break down exactly what happened on the charts, why it happened from a macro and geopolitical standpoint, and then we're going to look at what the next key price levels are telling us. There's also a poll coming up mid-video, so stay locked in for that. Let's start by setting the stage. Heading into the first week of March 2026, crude oil, specifically WTI, had been grinding through a period of relative consolidation after a volatile February. Throughout February 2026, prices oscillated in a range broadly between the high 70s and low 80s per barrel, reflecting a market that was absorbing competing signals, demand uncertainty from China's uneven post-holiday recovery, ongoing OPEC Plus production decisions, and a US dollar that had been showing intermittent strength due to Federal Reserve policy expectations. Then came March 7th. On that single session, WTI crude moved from around $82.50 per barrel, which had been acting as a near-term support zone, all the way up to approximately $84.70 per barrel at the intraday high. That's a move of roughly 2 out of 20, or just over 2.6%, which rounds to that 3% figure you've been hearing about. In terms of daily price action, that kind of single session move is notable. It's not historic, but it's the sort of candle that gets traders paying attention because of both its size and the context around where it came from on the chart. Now let's put that 82 Aus 50 level in perspective. Going back through late February price data, that level had held as support twice before, once in the third week of February and again just days before the March 7th move. Every time price tested that zone and held, it was essentially the market communicating that buyers were willing to step in there. When you get multiple touches of a support level without a breakdown, you build what technicians call a base, and that base becomes the launch pad for the kind of move we saw on March 7th. The 84.70 level, meanwhile, is worth watching now for a different reason. It sits right at a prior congestion zone from earlier in February, where price stalled and reversed on at least one occasion. So what was resistance before is now the area the market just punched through, and that's how support resistance flips work in practice. The question now is whether that $84.70 level can hold as support on any pullback, or whether it simply acts as a ceiling the market needs more time to digest. So what drove this move? This is where it gets interesting and where the macro picture intersects with the chart. The most commonly cited catalyst on March 7th was a fresh escalation in Middle East tensions. Reports surfaced regarding renewed hostilities in the Red Sea corridor, involving attacks on commercial shipping that raised immediate concerns about supply disruption risks. This is a pattern we've seen before. Any credible threat to oil transit routes, particularly through the Strait of Hormuz or the Red Sea, tends to inject a risk premium into crude prices almost instantly. What's important to understand observationally is that the actual physical disruption to oil supply doesn't need to materialize for prices to react. The market prices and perceived risk. When tanker operators start rerouting ships around the Cape of Good Hope to avoid the Red Sea, that adds days to transit times and raises shipping costs. And traders respond to that uncertainty by bidding prices higher. In February 2026, we had already seen some of this dynamic playing out, but the March 7th developments appeared to represent a fresh escalation rather than continuation of an already priced-in situation. There's also a seasonal demand component worth noting. Refinery runs in the United States typically increase heading into the spring and summer driving season, and inventory data through late February had been showing some drawdowns at the Cushing, Oklahoma hub, the delivery point for WTI futures. Tighter inventories, combined with a geopolitical shock, create the kind of compounding catalyst that can produce exactly the type of sharp single-day rally we observed. Now, let's talk about what levels to watch going forward. And this is purely an observational exercise, looking at where the chart structure suggests inflection points may exist. We are not making predictions about where prices will go. We're simply identifying the areas where the market has historically made decisions. On the upside, the first level of interest sits around $86 to $86.50 per barrel. This area represents a prior swing high from mid-February and would be the next meaningful resistance cluster if buyers maintain control above the $84.70 area. Beyond that, the $88 to $89 zone comes into focus, which aligns with levels last traded in late 2025 and would represent a more significant recapture of territory the market lost during the broader February consolidation. On the downside, the $82.50 area remains the key reference. A clean break and close below that level would be significant from a structural standpoint, opening the door toward the $80 to $80.50 zone, which is a psychologically important round number and an area of prior support from earlier in the year. This is a good moment to pause. I want to hear from you. I've set up a poll and I want you to vote. Where do you think WTI crude oil closes out the month of March? Option A, above $87. Option B, between $83s and $87. Option C, below $83s. Go ahead and vote right now. The results are showing up in real time, and I'll come back to them at the end of this video. While that poll runs, let's zoom out briefly. The broader narrative around crude oil in 2026 continues to be shaped by three overlapping forces. OPEC plus supply discipline, which has remained relatively firm, demand growth expectations that are positive but uneven across regions, and geopolitical risk, which, as we saw on March 7th, can inject volatility at almost any moment without warning. What makes the current setup observationally interesting is that the market appears to be at a genuine inflection point structurally. The base, built at $80.50, the breakout on March 7th, and the proximity to key overhead resistance all converge to make the next 2 to 3 weeks a meaningful period to watch. Whether the bulls can consolidate above $84.70 or whether the bears reclaim control below $82.50 will likely tell us a great deal about the medium-term directional bias. All right, let's check back on that poll. The results are coming in, and the breakdown is genuinely interesting. Wherever the majority landed, it reflects the exact uncertainty the market itself is grappling with right now. There is no clean consensus, and that ambiguity is itself informative. It suggests traders and observers alike are treating this as a genuine decision point, rather than a foregone conclusion in either direction. To wrap up, March 7th gave us a textbook example of how geopolitical risk, technical structure, and supply chain concerns can combine to produce sharp single-session moves. The $80.50 to $84.70 range is now the defining short-term battleground for WTI crude. Keep those levels on your radar, stay informed on developments in the Middle East and on shipping route disruptions, and as always, none of what we've discussed here is financial advice. This is purely observational and educational. Do your own research, consult appropriate professionals, and make decisions that are right for your own situation. Thanks for watching. Drop your thoughts in the comments below, and we'll see you in the next one.